Hey, thank you for joining in today. This is KK from TK Financial Group. So this is a set of series of financial planning that I'm going to be talking about. So hopefully you'll pay attention and you'll get something of value out of it. But please don't forget to subscribe below. You can also like the video and please share it with anybody that you find that can find value from this too as well. All right, so today we're going to be talking about financial planning. So we talked about there's 6 different steps of financial planning. So the first step and the most important one is finding out a budget. If you don't have a budget, there is no way we're going to be able to know where we're going to go. So I'm going to show you a budget on the side screen over here, and we're going to be talking about just about each different line so you can input it in. So you can actually create this off an Excel spreadsheet, or you can do it the old-fashioned way, just write it down on a piece of paper and add it all up. That would be the best way to do it too as well. So we got a client over here called Harry and Deborah, and what we're going to do is we're going to split their incomes up, and we're going to do monthly and we're going to do yearly. And the reason why I do it 2 different ways is because you usually calculate it monthly, but you'll also like to take a look at the yearly amount too as well. It becomes exponential. So with this one here, Harry and Deborah, so we're going to input their monthly income in there and we're going to input their yearly income in there. Now just remember is that when you're inputting the income, it's not gross income, it's your net income. So look at your paycheck and take that net amount on there. So if you're getting paid twice a week, not twice a week, sorry. If you're getting paid twice a month, so bi-weekly, you're going to take that pay amount and multiply by 26, which will give you a yearly amount. And then you can just divide that by 12 easily and then put it on the monthly amount. The next thing we're going to take a look at, fixed expenses. So fixed expenses would be like your mortgage. So how much are you paying towards your mortgage, including the interest rate and everything? And then your property tax. Sometimes you'll find that you have your property tax included in your mortgage, and that's okay. You don't need to split it. You can just put it into the mortgage amount. Do you have your house cleaned? If you do, you should put your cleaning expenses in there too as well. Don't forget about all the cooking stuff that you do, so your gas, your utilities, don't forget your water and sewer, that also needs to be included. If you have a security system too as well, don't forget to input that security system number amount in there too as well. And then obviously the most common thing is your cell phone. Now, if you have 1 cell phone or up to 4 cell phones, I guess it depends on whether you have any kids or not too as well, so you can input that in there. And then internet, phone, and cable. And I put phone, I mean, not a lot of people have a home phone anymore, but whatever, it's usually combined with internet and cable, so you can put that in there. The next one is transport. So transport, we calculate gas and fuel. So what I usually do is I collect my receipts, or you can look this up on your Visa statement too as well, and just kind of take a look at all your gas bills there and just add it up for the month, and you can put your gas in there. Your finance too as well. So if you have a car, you can put your finance value in there or a lease amount, either way. And then if you have a second car, same thing. Now your car licenses, so you have to pay for your car license, which is your driver's license, and you also have to pay for the plates too as well. So don't forget to input those 2 in there as well. I usually put in about $20 a month for each one, and that should be enough for it. And then there's also insurance and banking. So don't forget, if you have any life insurance, you should put that amount in there. Car insurance too as well. Obviously, everyone has to have car insurance. If you have home insurance, that goes in there. Now, any sort of fees that you have with banking, sometimes the banks will charge you $14.95, $6, $5. Some banks will not charge you any fees. So just input the fees that you're paying in there. And then we go on to the savings part. So the savings part, let's see, Harry has to save for an RSP. That amount has to go in there. And then Deborah is also saving for an RSP, so that amount will go in there. Now, don't forget, when we're doing financial planning, we're always doing things that are preventing bad things from happening to you. So one is an emergency fund. We should be putting an emergency fund in there. Now, I've left the other one kind of blank. It's called Client 1, but we can put that particular one as a TFSA, so a tax-free savings account. And that you can also use that as an emergency fund too as well. So that'll give you a total fixed expenses. Now, this is the hardest part of working out this whole thing, is the variable expenses. And this probably would take the longest time. So under variable expenses, we got eating out. And that's hard to figure out because month to month it kind of varies, but you're going to have to kind of take an average of where you're going. Clothing expenses on a month cycle, groceries, so whatever groceries you're purchasing, whether you go to Loblaws, Metro, Sobeys, Costco, wherever else. And one important thing, and I always find this with clients, is gifts. When I mention gifts, they're like, "Oh no, I don't give gifts." Well, don't forget, when you're giving gifts, it's about Christmas, it's about birthdays, it's about Easter, those kind of gifts. You are going to give birthday gifts to people, and you are going to give Christmas gifts to people, so they're going to be in there. You should have some sort of vacation fund in there too as well. I know a lot of people, we go out on a yearly cycle to on a vacation, but we don't put any money aside. It's sometimes whatever we have available. But when you're working out a budget, it's always better to put a vacation fund in there. And then any household goods that you're using too as well. Now, LOC is considered a line of credit. So if you have a line of credit that you're borrowing from, that should also be included in there. How much are you paying for it on a monthly basis? If you're paying $200 a month, that should come out of there. Any credit cards that you're also paying on a monthly base. So I put TD credit card, Amex, Costco MasterCard too as well. And maybe you took out a loan for your RRSPs, and some advisors will advise that. I will not, but some advisors do advise you to take out a loan for your RRSPs, and you can put that in there and how much you're paying back that loan. The last one is personal care. So what personal cares do we have? Well, we have haircut, we have pedicure, manicure, hairstyling, whatever else. Maybe you go to the massage therapist once a month. Don't forget to include that there. So now what we're going to do is we're going to add up all of these expenses, and then we're going to subtract it from the only one thing you got is your income. And that'll give you a total amount. Now that total amount, if it's negative, that means you're running into a negative cash flow at the end of the month. And if it gives you a positive, that way you know you got extra money left over. Now, I want to tell you about something that's very important. And this is a person had told me this long time ago, and it was Warren Buffett. And how did he tell me this? Through the TV. The way you save is different for everyone. The people that cannot save have a certain formula, and the people that can save have a certain formula. So I want you to pay attention to this. When you are saving, remember, you have your income, you have your expenses, and you have your savings. And that's the way a lot of people look at it, is income, your expenses, and then whatever you have left over, you save. And that's not what Warren Buffett says. It has to be the other way around. You have your income, you save, and then you can spend. So your expenses should be the last line. And you'll find if you flip those two things around, you'll start actually saving for your retirement. And if you have any more questions, please don't hesitate to ask. Now remember, subscribe on YouTube. Please like this channel too as well. Please share this with anybody that you can find of value. I'm also going to post another 5 more videos on financial planning, and then we'll get into how we work everything out in detail. But don't forget, share it, like it, and subscribe to my video. Take care. Until next time, it's KK from TK Financial Group.